Hi, everyone. Thank you so much for joining us today for part two of the overview of the 7 pillars of a successful sales tax strategy. Before we get started, I'm going to go over a few housekeeping items and then we will jump right in and Mike will take it from there. First and foremost, if you are here for CPE credit, we do need you to do a couple things in order to receive that CPE credit. We will need you to fill out the poll questions as they pop up on your screen. If you have any issues with those poll questions, please just send me a message, let me know, and I'll help you get that sorted out. And you also need to fill out the survey at the end of this webinar. It will automatically pop up for you as you exit, but it will also be emailed to you in 24 hours. So if you do both of these things, we will be able to award you CPE credit. A couple other important things to take note of here. If you have questions as we're going along, please reach out and ask those questions. You can use the Q&A button in the middle of your screen. If you move your mouse around, it should pop up for you. And we're going to do our best to address them at the end of this webinar or follow up with you via email. I'm also going to be linking the slides here in the chat feature in a moment. They're also already uploaded to Zoom and will be emailed to you in 24 hours. So there's a few ways to get your hands on the slides and handouts. And let's go over our pre-recorded CPE. We do offer pre-recorded CPE. It is included with our Salt Vault membership. And, also there's a whole list of things that are included with that Salt Vault membership. The price of a consultation is actually up $5.95. This is old slide will update, but that's included with the Salt Vault membership. And you can also purchase those pre-recorded CPEs one-off as well. And if you have questions about that, just visit our website or let me know. And a couple quick introductions. First and foremost, for Sales Tax and More, we are a full service consulting and solutions firm, and we have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, exemption certificate management, audit defense, and like our name states, more. So if you have questions about our services or you'd like to work with us, please reach out. We would love to hear from you and we'd love to work with you as well. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well rounded and he has helped thousands of companies of all sizes and in all industries and is especially well known for his work in the e-commerce industry. And Mike, with that, please take it from here and thank you everyone for joining us.
All right, welcome everyone, and thank you for that introduction, Ellie. As always, we've got a lot of ground to cover today. We're going to talk about some action items from part one. We're going to talk about certificates, returns, registrations, audits, and then open it up for questions. But before we do, Ellie, you want to do the first poll question here?
Absolutely. And a quick reminder for everyone on these poll questions, you do have to fill these out in order to receive CPE credit. We just want to know, were you able to join us last week? It's okay if you weren't, but this is part two of the overview and we hope you were able to. And if not, please join us for future webinars. Mike, I will leave this open and you can carry on and I'll close it out in a little bit here.
Okay, thanks, Ellie. All right, so the action items from part one. Number one, determine your nexus footprint. And nexus is just a fancy word that means link or connection. And it's the link or connection with a state that has to be present before that state can require you to do anything. So after you determine your nexus footprint, you need to determine if what you sell is taxable and have a process for applying that taxability to your transactions. Number three, you have to have a reliable source for rates. And then number four, you have to have a use tax accrual process in place, and perfection is not the goal. Sometimes if you're trying to be perfect, trying to make sure that you're capturing all of the tax on all of the transactions you should be including for use tax. This is usually a tax on the purchases that you're making. It's cost prohibitive. So you want to be catching most of the errors, but there comes a point, we're not shooting for a 100% accuracy in this. It would be great if we could, but generally we just want to catch the majority of the stuff that's going through there. All right, so let's get started on today's points. We're going to start with exemption certificates, today's pillars, I should say. Exemption certificates is the first pillar that we're going to cover today. And once you're registered, you don't have a choice. You must either collect the sales tax on a taxable sale or collect a properly completed certificate in lieu of collecting the tax, which is acceptable to the delivery state. Remember when we talked about rates, sales are sourced generally in at least on interstate uh, transaction to the delivery state. So if the sale is being sourced to the delivery state, then we want a certificate that is going to be acceptable to the delivery state. Now, there are lots of types of exemptions out there. And if something is exempt for everyone, then you don't need any type of exemption certificate. For example, groceries, something that is exempt in quite a number of states out there. And if it's exempt for everyone, you don't need a certificate. But here are some examples, very common examples of certificates that you would need some type of documentation. Resale certificates, manufacturing certificates, entity type certificates like a nonprofit. So there's lots and lots of them out there, but these are the three that we see most often. So when is an exempt sale not exempt? When it's not properly documented. And this is quite a big issue. If we go back to 2008, 2009, it really wasn't as big as an issue because back then they gave you a lot of latitude when it came to certificates. And some companies, like distributors and wholesalers, they didn't even get audited because the state said, why should we spend all our time and money here? There's not any money for us to find. So when it came to certificates, the auditors gave you a lot of latitude. That started to change in that 2008 to 2009, 2010 period during that Great Recession. States needed a lot more revenue. And they said, how can we find this? And they started looking at some of the statutes and laws, rules, and regs that they weren't enforcing. And one of them was certificates. So prior to then, it was really a matter of substance over form. So if the auditor could tell that it was an exempt transaction, you got a lot of latitude there. But now what happened is it moved to a matter of form over substance. In other words, you have to have every I dotted, every T crossed. It's got to be on the right form. Um, so it's, got to be signed and dated, and anything missing is going to cause this to be set up in the audit. So, they did this and they raised a lot of money. So you would think that, once they got through that tight period there, they'd go back to doing it the old way. Unfortunately, not so. Once they saw how easy it was to catch companies that were not managing their certificates correctly, they saw it as low-hanging fruit, and it's actually increased rather than the states backed off. And right now, if you have a responsibility to collect certificates, this is the number one issue for large assessments in audits out there. Use tax, which we talked about in the last webinar, if you don't have it's either the number one or two issue. If you don't have a responsibility to collect certificates, then use tax is usually the number one issue out there for large assessments. So because audits are done on a sample basis, even one missing certificate can have a huge impact. I use this example all the time. I was involved in an audit, and it was a Texas audit, and we got involved after the initial phase. They asked us to help them during the redetermination, and it was a $3.5 million audit. About 60% of that was related to $3.5 million assessment, not audit. $3.5 million assessment. 60% of it was related to the certificates. And we did a pretty good job in this audit. We got everything, pretty much removed, except for one. We found all of the certificates. We tracked them all down, except for one. And this was to an individual, and that individual had disappeared off the face of the earth. And the company had sold a piece of heavy earth moving equipment to them. So the tax on this would have been about $8,000 or so, which no one wants to pay that. However, because audits are done on a sample basis, when you extrapolated out the error percentage for that one certificate, it had like a $270,000 impact on the audit. So even one missing certificate can have a huge impact. Now, people usually say, well, Mike, why didn't you just get them to remove it from the audit? Well, we had already gotten the audit down to pretty much zero, $17,000 or so from 3.5 million. And the state said, no, we are not removing this. We're leaving it in there. We had used up all of our failures. We even got some refunds included in that audit. And refund inside of an audit is generally a good thing because the interest that they're going to pay you on that refund is a heck of a lot less on any shortages that you have due to the audit. So they would not let us remove it. They would not let us detail it. So they kept it in the audit, and the client was still happy with us. We took a $3.5 million audit down to just under $300,000. 270 or so for this one missing certificate. They would have been a lot happier if we could have found it. They couldn't find this individual either, and for some reason, they never collected the certificate to begin with. So most people don't have invoices that would have $8,000 worth of tax on them, but the concept is the same thing. Most people have a lot more missing certificates, and it's cumulative. They have an outsized impact because of the way audits are done. Now, you can't just be collecting a certificate. Someone's got to be validating them also. When I talk about validation, it means that you're checking these certificates for the most common reasons that they could be kicked during an audit. So this is something you can do on your own. It's also one of the services that we offer, certificate validation. And there are other companies out there that do the same thing. Now, when we're talking about certificates, part of the validation process has to be, does it make common sense? And in order for something to be accepted in good faith, it's got to make common sense. It's got to be completely filled out. It's got to be on the correct form. And if you're accepting something in good faith, then if there's a problem with that certificate, the state will generally issue the one who issued the certificate. So that's generally going to be the purchaser. If they're the one who's issuing the certificate, the state will pursue them. But if the state deems that you didn't accept it in good faith, then you're going to be on the hook for that. I'll give you an example. This is a Texas sales and use certificate, and these are some very common mistakes. It's just not completely filled out. So everywhere there's a circle, these are very common areas that are left blank. And if they're left blank, they're going to be kicked during an audit. I mean, sometimes they're not signed. I'd say that's the biggest one. They're not dated. So you got to make sure that it's on the correct form and that it's completely filled out. Now, when we talk about common sense, if you look at the bottom left-hand corner, it says description of items to be purchased. And then in the top right corner there, it's a description of the business. So let's say that the description of the business is a software developer, and the items to be purchased are desks. Does it make common sense that someone who develops software is purchasing a desk for resale? No, not usually. So at the very least, you got to ask an additional question. Why are you buying this desk for resale? Oh, well, we just went into a new line of business and now we're going to be selling desks. So that's why we're buying this. Okay, that makes sense. Um, but it makes more sense that they're going to be using it for their business. So at the very least, you have to ask additional questions. Because if the auditor gets to this and they see this and you don't have the answers as to why you accepted this certificate, you're on the hook. There is no God-given right to an exemption out there. Since the seller is going to be on the hook for this, the seller has to pick and choose what they're going to accept. They got to make sure that it's going to survive the auditor's review during an audit. So if you're accepting something in good faith, by the way, the auditor cannot put on their detective's hat. But if it's kicked during an audit and you usually get time to get it fixed and or collected if it's missing, but now it's subject to additional verification. Now the auditor gets to put on their detective's hat. So you want to make sure you're collecting these in good faith, that everything makes sense, completely filled out on the right form, and that there's an actual exemption to be had. This way, you don't want that auditor. Once they put on that detective's hat, they'll find something wrong. So we want to make sure that they're all there and they're all valid um, before the auditor gets to see them. So one of the areas where certificates become a huge issue is in drop shipping. And drop shipping is a fulfillment method where the seller does not have the inventory at the time of sale. Instead, when the seller makes a sale, they're going to purchase the item from a third party and then have that vendor ship it directly to the customer. And the nexus of the customer never determines, this is the vendor's customer, that never determines where the tax is collected. Remember, it's the delivery state that we said. So because there's three parties here, this gets very, very confusing. And a lot of times we're going to say, well, what do you need a California certificate? I'm in Texas. I don't need to give you, I'm not registered in California. How can I give you a California certificate? You need to take my Texas certificate. It doesn't work that way. Um, when someone is registered to collect tax, they have to collect the tax or a certificate in lieu of the tax that's acceptable to the delivery state. So this is a huge issue because of just people think a sale for resale is a sale for resale, and unfortunately, it's not. If it's not a sale for resale is not properly documented, it becomes a taxable sale. So, important thing to remember, we don't ever ask our customers in non-drop shipping scenarios, hey, where do you have Nexus? Because I'm only going to charge you tax where you have Nexus. It doesn't work that way. I got to charge tax wherever I have Nexus. So just because we add another level of complexity here doesn't change the basics. It's where the item is being delivered. That's where the certificate has to be accepted. Now, states don't make anything easy. There are 10 tough states out there that say, at least under some circumstances, you have to be registered in my state in order to issue a valid certificate. The rest of the states offers accept some type of alternative documentation. Now, these are the 10 tough states. And Tennessee was on there. We removed them as of January 1st, 2022. Um, but Illinois used to be an honorable mention, and now they're the number 10 state. Illinois says you can accept other types of documents. However, if you accept anything except for the state-specific form, then you're open to additional verification. In other words, the auditor is going to put on their hat. And we never want the detective's hat. We never want auditors to put on their detective's hat. So our guidance to our clients is that they get registered in the state of Illinois. And if they don't have taxable sales, if they don't need to be collecting the tax, there's a type of registration in Illinois It's called a resale registration. And you get registered just so that you can use the Illinois certificate with an Illinois number, but you don't have to collect tax. So a lot of people try to do that, end up getting registered for the retailer's occupation tax, and then they have to collect tax. But you want to make sure you're getting registered for the reseller's uh, registration. Very, very important. In some of these states, like California, it's pretty much you need to be registered there to issue a certificate, a valid certificate. In other states like Florida and Louisiana, it's only if the inventory starts out in that state at the beginning of the sale. So let's say that you have warehouses in Georgia and Florida, and you're making a delivery into Florida, but you don't know what warehouse it's going to come out of at the point of sale. So you'll decide that later on. So some companies will say, well, we need the Florida certificate no matter what because we don't know where we're going to ship from. So we want to be covered just in case we use it. So where the inventory is at the beginning of the sale is different in the states of Florida and Louisiana. Now, this is a great chart, and this is in our salt vault that Ellie was talking about earlier. Um, if you're doing any type of drop shipping, whether you're the vendor who's shipping for someone else, or whether you're going to the vendors and asking them to ship directly to your customer, this will tell you what alternative documentation is acceptable in that state. Because of course, states never make anything easy because they all don't accept the same type of documentation. So we're going to go through some examples here. New York is an example of a delivery state certificate um, that will allow you to use a home state number. So if you don't have Nexus in New York and you're not required to be registered there, you can download this certificate off the internet. Um, just do a Google search and you can pull this down. And when you're filling this out, you want to make sure you top left side hand side, you're going to put the seller's information. The top right hand side, you're going to put your information. This next box is important here. Mark an X in the appropriate box. Single use, that means this certificate's only good for one transaction, or blanket certificate, which means that all of the transactions of a similar nature are going to be covered. You're going to want to fill that out because every time you purchase from someone, you don't want to be filling out a new certificate, nor does your vendor want to be asking you for a new certificate. I mean, it gets a little bit tiresome. So you'll want to fill out blanket certificate. Then you come down here. I'm engaged in the business of blank and principally sell blank. That's for that common sense provision we were talking about. And then you're going to skip part one. Part one is for people who are registered in New York and are required to be registered in New York. So you're going to skip part one, go down to part two, and you're going to certify that you're not registered, nor you're required to be registered as a New York State sales tax vendor. Then you're going to tell them where you are registered and give them your registration number. If you're from a state like Oregon that doesn't have a sales tax, then you would tell them Oregon and not applicable when they ask for your number. Also works for countries. So you could tell them Canada and then give them your value added tax number, your GST number. All right. So here's an example of a no nexus statement. So on this, and this has been cut off, Ellie. We need to expand this so we can see line number 8 on this. Um, on this here, again, you're going to fill it all out. You want to make sure that you're checking that it's a um, blanket certificate. You're going to go down to box number 3. It says property will be resold under license ID number. You could put not applicable in there if you're not required to be registered in Pennsylvania because if you look in the brackets, it says if purchaser does not have a Pennsylvania sales tax license ID, include a statement under number 8 explaining why a number is not required. So you would skip down to box number 8, you check box 3, and you check box 8. And in box 8, you write in, we do not have Nexus in Pennsylvania. So this is an example of using a no nexus statement on a delivery state certificate. All right, here's the streamlined sales tax certificate. And if you're doing a lot of drop shipping, I suggest you use this as the multi-jurisdictional certificate. It only works for 24 states, but if you remember the streamlined sales tax organization, then you have to accept alternative documentation, including a home state number. So this is very, very good. You fill out the front side of the page here. And then here's the second, actually, this is all on one page now. This is the bottom of the page. And if you're actually registered in one of these states, then you write down your registration number. But if you're not registered in one of these states, you just put your home state number. All right, so here are some certificate best practices. Number one, you have to have a system. Got to have a system in place. Too important not to. You got to decide who will manage it. Is it going to be the accounting department? Some people have the accounts receivable department. Some people have the credit department. Some people have the sales department handle it. Sometimes that works well, but in the biggest problems I see come when you have the sales department managing it. And some of that comes because they just don't understand tax and the importance of it. And the second part of that is some salespeople are more worried about their commissions than they are about the health of the company. And whenever I do a review of certificates out there, I find the most problems when the sales team, not always, sometimes the sales team is great at making sure everything is done by the book. But sometimes, and I joke here, there's a certificate. I see birth certificates, marriage certificates. If it says certificate, you got a sales guy collecting it because they care more about their paychecks. Not universal. We have run across and worked with very many good sales departments. All right, so you got to decide who's going to be in charge of collecting the certificates. In other words, who's going to manage it, and then who's going to validate it. So sometimes you want a different department validating than the department who's collecting, or you can outsource that to a third party like ourselves. How are you going to store the certificates? Well, in this day and age, you want to centrally store them and have them digitally accessible to everybody who needs access to them. Uh, I was involved in a situation where each one of the regional offices was operated almost like an individual company. They all stored the same certificates. One had no clue what the other one was doing. They stored their certificates in filing cabinets. There was no digitation. They weren't centrally located. So when they get audited, it's a nightmare trying to track all of this stuff down. And it became an even bigger issue from them. I got uh, called in on this because their vendors were short paying them and they weren't communicating. So the parent office said, "Hey, what's happening here? We got all of this short pays, and it was going on for like 6 or 7 years, and um, you know, they pay on an accrual basis, so they paid all this tax into the state, and then they got short paid. They're going back to try to get refunds, and the statute of limitations is there, and they can't even get the refunds. And these people should have been exempt, so it's kind of hard to make them pay the tax. So it can become quite a problem. You want to make sure that your certificates are stored centrally and digitally and available to whoever needs them. And some certificates are going to expire. Obviously, you're going to need to replace the certificates that are expiring, but a lot can happen over a 3-year period. And that's, generally companies are audited every 3 years. So you want to be updating your certificates for existing customers at least every 3 years, in my opinion. Uh, I had one, I went out and I reviewed this company's certificates. They had one certificate that was 27 years old. And this company had even changed states. They moved from Texas to Oklahoma. A Texas certificate's not going to help you when you're in Oklahoma. So it had changed entity types. It had changed ownership multiple times. I mean, anytime a sales tax number changes, you need a new certificate. So a lot can happen in that 3-year period. So you want to make sure that the certificate you collected and was probably valid when you actually collected it is still valid today in case you get audited today. Ellie, let's go to the next polling question.
Yeah, we have a little bit of a quiz for you. So, which of the following is not true? Your choices are even one missing certificate can have a big impact in an audit. Certificates are not an important issue for pure wholesales. Dropshipping can complicate certificate issues. And the next customer never influences where or when, sorry, I got to explain this, tax is charged. And you're looking for which one is not true. So, Mike, I'll leave this open and then you can move forward.
Certificates are not an important issue for pure wholesalers. That is the one that is not true. They're very, very important for pure wholesalers because if a transaction is not properly documented, then it becomes a taxable transaction. So if we go back to that 2008, 2009, if we go back before that, certificates were not a big issue for wholesalers, but today they're a huge issue. Back then, a lot of wholesalers weren't even audited. Now they're a great target for states because they realize that companies still are not managing their certificates the way they're supposed to, and they see that as low-hanging fruit. So very, very important for wholesalers to pay attention to their certificates. A lot of wholesalers say, oh, well, this is an exempt sale. The state will work with me. Not so much. They see that as low-hanging fruit. You got to document it. Otherwise, it's if you can't document that it was actually uh, an exempt transaction, the state's going to treat it as a taxable transaction, and wholesalers will end up paying money during an audit. All right, so let's move on to registrations and sales tax return filing. One of the biggest questions we get is when and where we should register. How should we register? Once we're registered, how often do we have to file? And uh, can you give me some common issues? Well, sellers should register whenever there is nexus, what they sell is taxable, the exposure is material, and a marketplace is not collecting. Now, material, that's my comment. States don't say that. States believe that once you have nexus in a state, you should be collecting pretty much from dollar number one. Um, I think we need to use common sense. Just because the state says that you should do something does not necessarily mean that it makes good business sense to do so. So we got to use some common sense. For example, if the cost of compliance is going to exceed the back tax plus penalty and interest, does it make sense to file? I say no. I say let the state track me down. I'll save money by letting the state track me down and pay the state out of my own pocket. An example, let's say, it's one of those states with 200 transactions. So you cross the 200 transaction threshold, but you're only selling a $5 item. So maybe you have $1,000 worth of sales out there. State says you should be collecting tax and paying the state. Well, if an average tax rate is 8%, 8% of $1,000 is $80. Even if you add 100% to that for penalty and interest, that's $160. I don't know how you can get registered. I mean, even if you're doing it yourself, time is money. And it's going to take you a little bit to get registered. Then once you're registered, you're going to have to file. Some states like Georgia, you're an automatic monthly filer. So every month you have to file. I don't know, even if you're doing it yourself, you can't do it for $160 a year. And if you're outsourcing it to someone like us, you definitely can't cover that. So I think we need to use common sense. And at that point, everyone says, well, Mike, what's the number? I can't tell you what is the number. I can tell you that um, used to be $3,000. Now it's more like $5,000. If your taxable sales are under $5,000, I find it hard to make the math work. Here's what people need to be looking at. I can't tell you what is material. Coca-Cola, $100,000. That's a rounding error. $100,000 to me, that's a lot of money. So you got to look at the risk tolerance. There are some people out there that can't sleep at night because they hear the state's footsteps. They think the state is going to find them very soon. Well, there's something to be said for peace of mind. So their personal threshold should probably be lower, probably be closer to that $5,000 than a higher number. Profit margins. This is counterintuitive. A lot of companies say, well, Mike, I can't afford to be compliant. I can't pay for this sales tax compliance. It's those companies that need it the most. Because if the average sales tax rate is 8% and you've got 50% for penalties and interest on that, you're looking at effectively 12%. If you've got a 2% profit margin and the state finds you 2, 3, 4 years, 5 years down the road, well, not only have you worked for free in that one state, you may have put yourself out of business. So the lower your profit margins, the bigger the need to have a lower personal threshold. And then there's capital reserves. If you got a lot of money, put aside for emergencies, you can be a little bit more risky. But even big companies, they have all their money tied up in inventory. And, I've had, $20 million plus companies uh, in the fourth quarter. The state of Washington caught one of them, and they wanted them to pay immediately. They couldn't do it. I had to work out a payment plan for them. So these are the things you got to look at when you're determining what your personal threshold is. And, if the state finds you, you're still going to have to pay them, However, you will have saved yourself a lot of money because uh, $160 to me, it doesn't make sense. You'll spend more money trying to be compliant than you would trying to do uh, let the state find you and uh, get that money from you directly. You pay them out of your pocket. So there are different ways to register. One is register prospectively, and sometimes this is what you should be doing. If you just crossed the threshold, you'll want to register prospectively. That is, with today's date or a date 30 days in the future or 45 or 60 days in the future. You could register historically. Let's go back to register prospectively. Some companies say, Mike, I either don't want to or I can't afford to take care of all this past liability. I just want to stop the bleeding. I don't want to dig myself a deeper hole. So I just want to register prospectively. And, you know, that'll work in a number of states until the states get aggressive. And there are about 6 or 7 states out there that are auditing everybody now to make sure that they use the right nexus date when they've registered. So it's you can do it, but you're rolling the dice when you do it. And in those 7 states or so, you can't do it at all because you're going to get audited. It's not a matter of if you're going to get audited, it's when you're going to get audited. What the states want you to do is register historically. And what that simply means is you use the actual date that the nexus was crossed. And once you tell them that, they're going to say, thank you very much. Now give us all these past back returns that you never filed and the penalty and interest on top of that. So another way to take care of the past that the states like is registering through a voluntary disclosure agreement. And a voluntary disclosure agreement, they're going to reward you for stepping forward voluntarily. They're going to waive the penalty. Some states, not very many. There's a max of 7 that waive some or all of the interest out there. And they're going to limit the look back period. If a state finds you, in theory, they can go back to the date that your nexus began. In reality, they only, and I say this tongue in cheek, they only go back, 7 to 8 or 10 years. I don't know of any states that go back 9 years. Most of them are going to go back 7, 8, or 10. So California, they'll actually go back 8 years. And if you do the VDA, it's 36 months. So uh, they reward you for stepping forward voluntarily. Now, sometimes if the state's contacted you, you cannot do a voluntary disclosure agreement. Not all the time. There are two states, Florida and Michigan, that come to mind where they'll still let you do the voluntary disclosure agreement. Um, but like California will not. If they've contacted you, they keep great records. Well, someone called you 2 years ago about this. You never responded to our call. And now you try to do a VDA, they kick you out. So there you'd want to register. And after you register, ask for a managed audit. A managed audit is when someone like ourselves comes out and under the supervision of the state, we do the audit. And because the state doesn't have to use their own people, they're going to waive the penalty and 50% of the interest. So those are the different ways you can register. Now, filing frequencies, very few states, I don't know if there are any left anymore, that allow you to choose your own filing frequency. Some states set your frequency by statute. For example, we mentioned Georgia earlier. The first 6 months, by statute, you are going to be a monthly filer. After that, they may adjust it or they may leave it the same. Some states set your frequency by estimated sales. So when you're telling the state what your estimated sales are going to be, you want to be fairly in the ballpark. You don't want to tell them, oh, I'm going to have $100 worth of sales and come in with 10,000. That's going to throw up all sorts of red flags. But they will set your frequency based on your sales. And the higher the amount of sales, the more likely you're going to have a monthly filing frequency. And pretty much all states, after a certain period of time, they're going to review and change your frequency. So in the beginning, even if you do fib and tell the state one number, they're going to pretty quickly catch it and have you changed. And the frequencies are monthly, quarterly, semi-annual, or annual. Not all states have a semi-annual. And the annual, everyone wants to be an annual, but it's hard to be an annual. I go back to materiality. Why are you even registered if you're going to be an annual filer? Some states say if you collect more than $80 worth of tax, you can't be an annual filer. So you got to be collecting less than $80 worth of tax. So your taxable sales, $1,000. Again, doesn't make sense to do that. So when it comes to sales tax return filings, you can do it yourself. You can hire a third party. There are sales tax specialists like ourselves. You can hire your existing accountant or bookkeeper, or you can hire a software company. Now, for those of you who've heard me speak before, I am not a big fan of software companies doing services. I mean, they're a steady source of referrals for us. Software companies should stick to what they do well, which is software. Even if they're sales tax companies, they mess up so many times when it comes to services. Now, if you do decide to go with a software company, there are two types of companies out there. There's your full service software company and then a limited service software company. I think if you're going to use a software company, you got to make sure they're full service. A full service software company would be a Vertex, an Avalara. They have different problems with Avalara. It's going to be customer service and them getting things wrong all the time. But a limited service company is like a tax jar, and they can't file certain types of returns. So what, give you an example, tax jar in Oklahoma, for some reason, they could not file the seller's use tax. So they told everyone to go out and register for the sales tax. Well, if you're a remote seller, very little to do with that vendor's use tax. They don't even charge you a fee to get registered in the state. But if you try to get registered for the sales tax in Oklahoma, they're going to charge you $25 just for the application. Then you got to get registered with the Secretary of State. which is $350. And then you got to get a registered agent, which, anywhere from $99 to $350. Now you got to renew that annually, and you're subject to income tax. So make sure that if you are working with a software company, they're a full service software company. And even then, I think that um, you don't want to be doing that. Software companies are good um, at software. All right, so points to consider when you're trying to choose a provider. How much time do you have to devote? Can the provider file all the returns you need filed? Who is going to be your point of contact at the software company? Is it going to be the person who's actually preparing your returns? With us, that's who it is. You can talk to the person who's you're assigned a staff accountant. You can talk to that person if you have questions about your returns. Is it going to be a customer service representative who's going to go talk to the person filing your returns? Or like Avalara, they went to a trouble ticket. I don't know about you, but that's a software solution. I personally don't like working with trouble tickets. Does the provider know the red flags and how to avoid them? We get into the red flags a little bit deeper when we get into the specific pillars. Um, what method does the provider use to balance tax collected and gross sales, forward calculation, or grossing up sales? We do tax collected and gross sales because if you're audited, I think these are the two numbers that the auditor is going to pay the most attention to. So we want them to be absolutely accurate. If we need to make adjustments, it's usually to exempt sales. A forward calculation, and this serves its purpose, but a forward calculation is when the company runs the rates and says, here's what you should have collected. And we have some clients who do that, less than 5%, who ask us to do it because they couldn't get the right rates at the point of sale. But TaxJar, they were doing this for everyone. They were ignoring what was actually collected and saying, here's what you should have collected. So doing this all of the time is not a good thing. And then grossing up sales. I think that that's an issue. And when it comes to audit, um, and the reason why you have to do something when you balance, when you're submitting returns, they'll get kicked if they don't fit for what the state is looking for. So you got to make adjustments. So these are all adjustment methods. I think the safest one is the tax collected and gross sales. You want to make sure those numbers are correct and any adjustments are made to exempt sales. All right, points to consider. Continued notice management. What do you have to do? I mean, some of these software companies, their idea of notice management is, hey, you got a notice. With us, we're going to solve that notice on a complimentary basis if it was the state's fault or our fault. And we're going to make sure that hopefully it's done before you even know about it. If it's your fault because you sent funds late, then there is a charge for that. But notice management to me is not, hey, you got a notice, go fix it. And so you got to ask, what actually is notice management and what's my role in it? Bank reconciliation. When you're filing returns, you often collect in dollars and cents, and the state's only accept in dollars. So there's going to be a difference there. You got to reconcile that somehow. There are early payment discounts. There are vendor discounts. So number one, if you're hiring a third party, make sure that you are getting credit for those. But if you're not, your sales tax liability account, often we have clients who say, well, I want to, balance to the penny. Not going to happen. So we give a report at the beginning of the month, letting people know here's all the tax you collected. That's what we request to file the returns. At the end of the month, we send out another report, say here's what was actually remitted to the states, here's the difference, and here's why there's a difference. Makes life a whole lot easier for the person who's doing the bookkeeping. So you gotta make sure that uh, somehow you're accounting for these changes. Otherwise, you're going to end up with all this money in your sales tax liability account and not know what happened. Give someone a whole lot of headaches. All right, so here are some of the red flags. As I said, we're going to go over the red flags in the individual a lot in a lot more detail. A pattern of filing returns late, pattern of filing substantial amounts of exempt sales, returns not balancing to what the state expects, and then incorrect forms, incorrect rates, incorrect applications of credits, forms completed incorrectly, etc. These are all red flags. They're not the only red flags out there. And why don't you want a red flag? A red flag means that you're all of a sudden on the state's radar. And too many red flags, you get chosen for audit. So the best practices, keep a record of all returns, filings, and payment confirmations. Keep all records for at least the statute of limitations plus a cushion in case you're audited. Check your accounts periodically to ensure all tax collected is actually remitted. We're seeing a bigger and bigger issue with this. Automation is great, but it's also easy to accidentally turn on tax collection in the state, and then it doesn't get remitted. So make sure your gross sales match your gross sales listed everywhere. All right, Ellie, let's go to the final poll question.
That should be up on everyone's screen right now. We just want to know, will you be joining us for our next webinar? It should be in a couple weeks here. We'll start our whole series of a broken down pillar by pillar version of these webinars. So all the pillars that we've gone over in these last two. And we hope that you will be joining us for those. So Mike, I will leave this open and you can move forward.
Okay. When it comes to audits, there's no way to ensure that you're never going to be audited. I don't know of a way. Sometimes, especially for smaller companies, audits happen through a lottery. That's how you're chosen for an audit. For larger companies like a Coca-Cola, you're automatically audited, whatever that state's auditing frequency is, 3 years, 4 years. So every 3 or 4 years, you're going to be audited. However, you can have some great policies in place to avoid large assessments by limiting the red flags, and by, well, two concepts here. One, if you're following these 7 pillars, you should have much smaller assessments, if any, when it comes to an audit. And then you can decrease the possibility of an audit, not eliminate, but decrease it by limiting the red flags. All right, so take care of the first 6 pillars. We just basically have said that. How are registered companies chosen for an audit? We talked about lotteries. We talked about red flags. Here's one. You ask for a refund, that could make you an audit target. Industry issues. Sometimes when the state finds out that the whole industry is doing something wrong, and sometimes they find it out by auditing someone and they say, well, we can't be doing it wrong. Everyone in our industry does it that way. They choose that industry and everyone in the industry gets contacted. Informants, employees, competitors, customers, they tell on you. Sometimes they're irate and they want their pound of flesh, and sometimes they'll actually get a percentage of the money that ends up being collected. So they get a bounty and a pound of flesh. All right, so initial steps to take when notified of an audit. You want to review your pillars. If issues are found, you can consider a managed audit. I mean, if you know the state's going to find something, throw yourself on the sword, and at least you can get penalty and portion of the interest waived in most states if you hire someone like us to do that audit under the supervision of the state. Doesn't mean that we're going to look the other way. You can't do that. But if you just know that it's so glaring a mistake that you uncover, then at least you'll save on the penalty and interest. You want to work to correct certificate issues. We call that XYZ work. You got to request missing certificates. If you find any certificates that you know the auditor is going to kick, try to get them corrected. You're going to request missing records from customers and/or vendors. You're going to look for offsets, and you want to review what the auditor is requesting. Auditors have a lot of influence concerning your audit. So while you don't need to be best friends with an auditor, we strongly suggest you try to have a good working relationship. You definitely don't want to alienate that auditor. The auditor's always going to have the last laugh. And I talk to some companies and they're bragging about how, uh, you know, up in Michigan, they put someone in an unheated room and that auditor was out of there in, 6 hours. That's not good because the auditor's going to go back to their office and set everything up in the audit, and you're going to have to pay a whole lot more money. And now you got a hostile auditor. They're going to have the last laugh. Or in Texas, out in a trailer with no air conditioning in the middle of August, you want to have a good working relationship. All right, so set one contact person. These are the best practices that you want to have message consistency. That person should have a knowledge of your business, access to records, and a knowledge of tax policy, that state's tax policy. Don't assume the auditor is your buddy. They're going to get you talking. The more you talk, the more information that you may supply, that could all of a sudden lead them down a rabbit hole. Answer questions, don't volunteer information. Work with the auditor to keep items off the schedule. It's harder to get them taken off once they're on there than it is to keep them off. Don't assume the auditor is right or wrong. There are a lot of brand new auditors out there. You got to question them sometimes. And if you don't like the answers you get, ask for documentation of the items you don't agree with. And don't be afraid to ask for the supervisor. Sometimes the supervisor will support their people, but a lot of times, if their people are clearly wrong, they'll correct them. After the audit, you want to make sure you have an exit conference with the auditor. You want to review your assessment. Was the assessment fair? Is there any factual error? And if so, is it worth appealing? Too many times, we're asked to take it to the next level, and you're just throwing good money after bad, because too much of this is based on feelings. So you got to, look at this. Was it fair? Was there any factual error? Do I have a chance of winning? That, you don't have a chance of winning based on feeling. Was there a factual error? And is that worth appealing? And then you want to appeal, you want to pay, or you want to ask for a payment plan. Most states are going to work out a payment plan with you if you need it. And always, always, always ask for a penalty waiver. If it's your first audit, you're very likely to get it. If there are extenuating circumstances, even if it's not your first audit, if you've worked with the auditor, there's a good chance they'll waive it. Interest, not so much. Takes an act of God to get interest waived in general. And then you want to correct any deficiencies because other states are going to find the same things and states are going to come back and audit you again. There are some companies that go through an audit and don't learn the lesson. They just keep the same policies in place. The auditor comes back in 3 years. They don't even have to look for new issues. They go back to the same old issues. So once you know what was wrong, what was a problem in an audit, make sure that you're correcting it. And Ellie? Got a little bit long today, but we have any questions?
We do. And just in case anyone has to leave here at the top of the hour, thank you so much for joining us. Again, if you have questions or you about our services, please reach out. We'd love to hear from you. We'd love to work with you. Other than that, if you have questions right now in this webinar, please submit them in the Q&A box. And Mike, so it looks like we have a question and a clarification. So I'll read this clarification. What type of documentation should a vendor collect from their customers that claim they do not meet the economic nexus for a specific state? Clarification: in Florida, where there isn't a form that has a no nexus.
Um, we're never asking our customers if they have nexus in a state for us to charge them tax. So if we have nexus in a state, we need to be collecting tax from our customer or a certificate in lieu of the tax. And it's up to the customer to determine what exemption they qualify for. So, in Pennsylvania, they're going to give you the Pennsylvania certificate and check that no nexus box. But whatever that state requires, That's what you need to be collecting, and you should not be telling your customers what certificate or what exemption they qualify for. Remember, you got to be accepting this in good faith. And good faith means that the customer gave it to you, not that you told the customer to go and fill this out. If an auditor knows that, you lose your good faith exemption. And if there's something wrong, they're coming after you rather than your customer. So it's your responsibility to charge the tax. It's the customer's responsibility, um, to let you know they're exempt and then to provide some type of documentation. Now, once they tell you why they're exempt, you can help them figure out the correct form. And each state has a different form that can be used. I showed you the acceptable alternative documentation. I suggest if you're doing a lot of job shipping to go ahead and uh, subscribe to that Salt Vault. That's a proprietary chart in there, and that'll tell you what you can or cannot accept in every state.
All right. Thank you so much. And we will, and someone wants to know here if we offer bulk sales of webinar. You have access to all of the webinars that were pre-recorded in the Salt Vault.
I,
Otherwise,
a bulk sale is a special type of transaction, and
oh, I didn't understand.
yeah, I read that the same way you did, and then uh, I think that what they're asking about is a bulk sale. And right
Okay.
now, we do not offer any webinars on bulk sales.
Thank you. Thank you so much, Mike. And thank you everyone for joining us. And we hope to see you on future webinars.
Sorry to step on your toes there, Ellie. Yes, thank you everyone for joining us today, and we hope to see you on the next webinar. Thank you. Bye-bye.